Let's shift gears, though, to another market story that we're watching today, and that is, of course, the bank earnings that hit the tape earlier this morning. Bank of America and Goldman Sachs both reporting before the bell. Bank of America missing on both the top and bottom lines. Big story for their business. Loans up, interest income up. They had a little bit more of an optimistic tone in terms of the overall picture for a recession because they didn't substantially increase their reserves for any loan losses like the other major banks did as well. But then you also flip the script and you take a look at Goldman Sachs. They're more of a money center bank compared to Bank of America. They're obviously more Wall Street facing. They knocked it out of the park, beating on both the top and bottom lines, very much thanks to good trading in their fixed income division. They were able to offset a massive drop in their asset management and investment banking businesses. Obviously, no IPOs, no debt issuance, so not a lot of activity going on in the capital markets space. But look, they leaned on their trading desks, and that seemed to be a pretty good story for them.
Well, just the very latest from the big banks. It's been interesting to me to hear the commentary coming out of these big banks in terms of how they view these recessionary concerns. Obviously, that top of mind, most of these banks warning about it. But over at Citi, that wasn't necessarily the case. Jane Fraser was sort of saying, look, we don't see anything that suggests that kind of recession is imminent. So obviously, we're focusing on these banks because we want to look at just how much lending is actually happening, the health of the economy as well. But it is interesting to see, yes, warnings on the horizon, but not necessarily all kind of on the same page in terms of where the economy is headed.
Yeah, and likewise, again, the net charge-offs right now and the amount of write-downs that the banks have had to take, whether or not you're a Wall Street bank or a more consumer-facing bank, is not taking up, at least as of this quarter. But you have Goldman Sachs, for example, David Solomon saying on the call this morning they've made the decision to slow hiring velocity. So there are signs that the banks are starting to get ready for the next chapter, which could be a little bit darker than they are right now. But let's get some more perspective on what's going on in the banking industry with an expert. Devin Ryan, JMP Securities, a Citizens company, is Director of Financial Technology Research there and joins us now live. Devin, appreciate you taking the time this morning. Give us the breakdown on what you saw from the bank earnings this morning. I know that you watched specifically JP Morgan Chase, Morgan Stanley very closely. Ugly, ugly quarter when you talk about investment banking, but it seems like there are some strategies to compensate for that, is there not?
Yeah, good morning, Brian. So, I think actually, if you back out some of the things that I would call noise or transitory, which is going to be marking to market the balance sheet at a lot of these firms for the big decline in asset prices, equity markets were down 16%. If you back that out, results were actually pretty good. Goldman Sachs revenues were up year over year, excluding some of the marks on their equity and debt investments. And so I think what that tells you is that they have a pretty balanced business model. And so I think you hit the nail on the head. Their trading results were very resilient, and that more than offset a little bit softer investment banking. And even within investment banking, the M&A advisory business continues to chug along. And, the equity and debt issuance markets are kind of shut down right now, but those will inevitably open back up. So Goldman Sachs put up a 10.6% return on equity in this environment. I think that very healthy. And then in terms of the outlook, I think, a pretty balanced position from the company. And that's just because there's so much uncertainty in the macro environment. But, Goldman's going to navigate this very well. They always do. They always gain market share through these tough moments and come out on the other side in a better position. And I think that's, you saw an early sign of that in their second quarter results.
Yeah, and Devin, I guess I wanted to follow up on that because, again, the big story appears to be right now that you're not seeing the impact of a recession right now in the Q2 results, but you're seeing these types of kind of commentary coming out of management that, well, they want to get ready if things do deteriorate in the next few quarters. So when you see Goldman Sachs saying, look, we're going to slow the pace of our hiring, that doesn't mean stop hiring, but these are notable types of things, right? I mean, do you see other areas in these reports that show you they're starting to get ready and very cautious about what could be around the corner?
Well, I would actually say I think you did see some of it in the second quarter. And one of the biggest areas is what the markets were doing, right? So equity prices, and depending on what index you're looking at, were down mid-teens to 20+%. Bond prices were also down. And so these companies all have to navigate that. And that put a lot of pressure on again, anything that you have to mark to market that you own on your balance sheet, and negatively impacted all the capital issuance, which is essentially very little in the quarter. And so firms are navigating that piece. On the credit side, I think it depends on what bucket we're looking at here. I think there could be some more pain that comes from the housing market's tightening up, and consumers are starting as a position I think very well in terms of where unemployment rates are, and you're still seeing consumers spend money, and so things absolutely could get worse here. And I think banks are always going to try to get ahead of the curve, and in cases where they can, take provisions. But we're still seeing a pretty balanced business environment versus one that is all negative. And I think that's what you heard from Goldman Sachs today, that they're still very engaged with clients. I think the trading outlook is very good. They really lean in, so they're a little bit of an aberration in the environment as well, where they go on offense when a lot of firms have to pull back. And so I think you have to look at company by company. But ultimately, I think there's definitely signs of tighter economic conditions because rates are going up at an unprecedented velocity here. But firms are navigating that, I think, relatively well. And again, I think you saw that in Goldman Sachs earnings today.
How about the capital story? And that wasn't necessarily as relevant for Goldman Sachs and Morgan Stanley. They didn't suspend their share buybacks, but you saw JP Morgan Chase, Citi do so. Wells Fargo and Bank of America did not suspend their share buybacks. But is there a concern that the capital story for these banks post-stress tests is going to change because they might want to preserve more on their balance sheet if there is some sort of deterioration in the outlook?
That's a good question, Brian. I don't think we're seeing that at a broad scale right now. What you're seeing is individual companies dealing with the outcomes of their specific stress tests, and you saw that at JP Morgan with the buybacks. Morgan Stanley, on the other hand, had a good outcome, and they have a $20 billion multi-year buyback. And from their earnings call, it sounds like they're going to be really leaning into buybacks given the decline in the share price over the past few months. And even Goldman Sachs today suggested that they're increasingly interested in buybacks given their stock price. Goldman Sachs trading at 1x book value in an environment where equity prices go down about as much as you can imagine. They still generated a nearly 11% return on equity. That is a mismatch where the market is already, I think, quite negative on the stock, well ahead of the fundamentals deteriorating. And so clearly, the fundamentals could deteriorate from here, but you're pricing in a lot of negativity when you're able to buy Goldman Sachs, a very high quality franchise, at 1x book value, and that's where you're able to buy it today.
Yeah, Goldman Sachs again down 21% year to date, essentially in line with where the broader markets have been. But Devin Ryan of JMP Securities, thanks so much for joining us. Appreciate you taking the time.